So JPMorgan just slashed their gold forecast. They took it from a soaring $6,000 all the way down to 4,500.
Yeah, that is a massive recalibration.
Right. Like, why the sudden drop? Well, it's because the fundamental rules of the gold market just broke.
They really did. I mean, taking a 25% haircut on a major asset class, that is a very loud signal to the market.
Exactly. And, the world is arguably more dangerous and politically fragmented right now than it has been in decades, but gold is just no longer behaving like that ultimate guaranteed safe haven.
It's not. What we are seeing in this analysis is it's a fundamental change in market psychology.
The easy narrative has completely fallen apart, hasn't it?
Oh, totally. The old way of thinking was basically that, gold asks whether the world is safe. Just, is there fear in the market?
Right. You just buy gold when the news looks scary.
Exactly. But the market has moved past that. Right now, gold is asking a much harder, much deeper question. It's asking, do investors actually trust the architecture of the financial system?
Okay, let's unpack this. Because to understand why JPMorgan slashed that target so aggressively, we have to look at the fundamental flaw of gold that triggered this downgrade in the first place.
Yeah, we have to look at the underlying mechanics.
And that core flaw is its absolute lack of yield. I mean, think of owning gold, like keeping a pristine, vintage classic car in a heavily fortified vault.
That's a great way to look at it.
Right. It is a fantastic store of value. It protects you from systemic financial risks because, just like that classic car, there's no issuer.
There is no government promise attached to it at all.
Exactly. If the entire banking system collapses tomorrow, you still have your car. But it doesn't pay you rent. It doesn't pay you dividends while it just sits there under a tarp.
It just sits there. To build on that, imagine that right next door to your vault, there's a fleet of taxis.
Okay, taxis.
Yeah, and those taxis represent government bonds.
Yeah.
Now, if you own the taxis, they are out on the street generating hundreds of dollars in fares every single day.
Making actual cash flow.
Yeah, right. So the opportunity cost of holding gold is the taxi fare you're giving up just to, stare at your classic car in the vault.
Man, that's a lot of lost fares.
Exactly. Because gold produces zero cash flow, it has to constantly, relentlessly compete with cash and bonds that actually pay investors while they wait.
So it all comes down to what you're giving up to hold the insurance.
Precisely. And we measure that using real yields.
Right, real yield.
Yeah, and when we talk about real yields in a conversational sense, we just mean the return you get on safer assets after you subtract the punishing effects of inflation.
So like your actual profit in terms of buying power.
Exactly. When real yields jump, meaning those safe bonds are actually beating inflation and putting real usable spending power in your pocket, the math of your portfolio just flips on its head.
Because suddenly holding that insurance becomes a massive luxury.
Yeah, you are actively losing out on profit by keeping your money in the vault.
But wait, if the world is politically uncertain and objectively dangerous right now, shouldn't gold be skyrocketing regardless of what bond yields are doing?
You think so, right?
Yeah. I mean, shouldn't raw fear override the math of a bond yield?
This raises an important question, and honestly, it targets the single biggest misconception operating in the market today.
Okay, lay it on me.
Gold does not rise simply because the geopolitical landscape is dangerous.
It doesn't.
No, it rises only when the value investors place on protection grows faster than the returns available from safer yield-bearing assets.
Oh, wow. So it's a race between the desire for insurance and the lure of income.
A race where the hurdles keep getting higher. I mean, if government bonds are suddenly paying you a hefty, guaranteed premium above inflation, institutional money will ruthlessly chase that yield.
Almost regardless of the headlines.
Exactly. The world can be incredibly tense, but if a hedge fund can lock in a guaranteed, inflation-beating return simply by buying U.S. treasuries, the bar for gold to attract that capital becomes extraordinarily high.
That makes total sense. If cash is paying you real money after inflation, you're making a profit just by sitting still.
Exactly.
So that explains the mechanics of why gold struggles against yield. But if the math of rising yields is so punishing to gold, it begs the question, who is ignoring that math and keeping the price from collapsing entirely?
Right. Who is buying it?
Yeah, like who is actually driving this potential $4,500 scenario we're seeing in the analysis?
Well, to map that out, you have to dissect the market into different tiers of demand.
Okay.
The absolute structural floor, like the bedrock of the gold market right now, is central banks.
Central banks.
Yeah, these are strategic buyers, and their mandate is entirely different from a hedge fund. They aren't looking for yield.
They want safety,
They're looking for an asset with zero counterparty risk.
meaning they don't want to rely on another country keeping a promise.
Exactly that. Like
Yeah.
when a central bank holds U.S. treasuries, they are holding a liability of the United States government. If relations sour, those assets can be frozen. But gold isn't another country's debt.
It isn't a bank deposit that can be sanctioned.
Exactly. It carries no promise that can be broken by a foreign politician. And because of that unique property, central banks are providing massive, sustained structural support to the price.
Effectively putting a floor under the market.
Yes, exactly.
Wait, but if central banks are steadily buying for strategic, long-term reasons, why do we see these violent price swings?
That is the key right there.
Because central banks aren't the ones causing sudden massive spikes, so why do the other buyers even matter?
Because central banks provide the floor, but marginal buyers dictate the ceiling.
The marginal buyers.
Yeah, these marginal players are the financial buyers. So
Yeah.
the ETFs, the macro funds, the algorithmic futures traders.
Momentum, guys.
Exactly. They are momentum buyers. When they see a trend forming, their algorithms kick in, they allocate billions of dollars, and their buying momentum actually becomes its own advertisement.
It becomes a self-fulfilling prophecy. Higher prices attract more media attention, which brings in fresh capital, which tightens the available supply, and suddenly it's a feeding frenzy.
A feeding frenzy that can evaporate overnight.
Wow, really?
Yeah, these financial buyers are incredibly fickle. They're hypersensitive to those real yields we talked about earlier.
Right, the taxi fares.
Exactly. The moment the U.S. dollar strengthens or bond yields spike, the algorithms recalculate that opportunity cost. If it gets too expensive to hold zero-yield gold, those financial buyers will rapidly step away.
And they will dump their positions fast.
Incredibly fast.
Here's where it gets really interesting. Because there is a third pressure point in our analysis, and it's a total paradox.
The physical market.
Yeah. We've talked about central banks and Wall Street funds, but we have to talk about physical demand. You know, everyday people buying jewelry in India and China, retail investors buying coins and small bars.
That's a huge part of the market.
It is. And there is this fascinating contradiction. We usually think higher prices mean a strong, healthy market. But in the physical gold market, sky-high prices mechanically destroy the affordability for regular consumers.
It functions as an automatic self-limiting mechanism.
Mm-hmm.
It acts almost like a gravitational pull on runaway rallies.
Because as the price shoots up, retail buyers are forced to pull back. It's not even a choice.
Right.
If you are a jewelry manufacturer in local markets and the price surges, your customers simply cannot afford the same volume of gold.
They just can't buy as much.
Yeah, they reduce their purchase sizes, they delay buying for weddings or festivals, basically hoping for a pullback.
And add to that the fact that local currency dynamics often make it worse.
Oh, how so?
Well, gold is priced globally in U.S. dollars. So if a local currency weakens against the dollar, the price of gold in that local country skyrockets even faster.
Right, a double whammy.
Exactly.
Yeah.
Retailers start carrying less inventory because the volatility is just too expensive to manage. We even see consumers bringing old jewelry back to the market to melt down and sell for cash.
So the very thing that signals a bull market, higher prices, actually weakens one of the core pillars of market support by pricing out the physical consumer.
Which brings us back to JPMorgan's target.
Right.
That dynamic is a primary reason why 4,500 is not a guaranteed book destination. It is a highly conditional scenario.
The constraint of physical demand means the market simply cannot float higher on its own without very specific, powerful macroeconomic tailwinds pushing it.
Precisely.
So what does this all mean for you listening to this analysis right now, trying to make sense of your own portfolio and the broader market? What exactly do we need to watch out for?
We need to look for specific signals.
What is the actual mechanical roadmap required to hit that conditional 4,500 target?
Our analysis identifies 4 specific macroeconomic conditions, basically 4 distinct signals that must align to build this bull case.
Okay, let's hear them.
The first condition is a softer U.S. dollar.
Because of that exchange rate mechanism we just talked about.
Precisely. Since gold is universally priced in U.S. dollars, a strong dollar makes bullion mathematically more expensive for international buyers.
Whether that's a central bank in Asia or a jewelry buyer in Europe.
Exactly. A softer dollar relieves that mechanical pressure. It automatically makes gold cheaper in local currency terms across the globe, which instantly improves its appeal and drives international demand.
Okay, so signal 1, we need a softer dollar to unleash global buying power. What's the second condition?
The second condition is less hostile real yields. Now, it's important to clarify the mechanics here.
Sure.
Gold does not require interest rates to collapse completely down to zero.
Okay, that's a relief.
Right. But investors do need to see a trend where the reward for holding cash and government bonds is slowly eroding. The opportunity cost, that taxi fare you're giving up, it has to shrink.
Right. The math has to tilt back in favor of holding insurance rather than chasing income.
Exactly. The third signal we need to watch for is a massive return of ETF demand. We established that central banks provide the floor, but broad institutional inflows are what historically create the explosive upside rallies.
And we should probably explain how that actually works behind the scenes, because an ETF isn't just, a paper ticket trading on a screen.
Far from it. When billions of dollars flow into a gold ETF, the fund manager doesn't just update a spreadsheet. They are legally required to go into the physical market, purchase actual tangible gold bars, and lock them away in a vault in London or Zurich.
Wow, so it's a physical squeeze on the market.
It's a massive vacuum. Institutional buying physically removes thousands of tons of supply from the open market.
That creates a genuine scarcity that drives prices aggressively higher.
Yes. But for that vacuum to turn on, institutions have to believe the macroeconomic environment warrants it.
Which brings us to the fourth condition.
Persistent fiscal and geopolitical uncertainty.
And based on the analysis, this isn't just about waiting for one dramatic, cinematic crisis on the evening news, is it?
No, not at all. A single news event rarely sustains a multi-year bull market.
It's more systemic.
Exactly.
Yeah.
What drives gold to 4,500 is a slow, creeping, structural loss of confidence.
We are talking about rising sovereign debt burdens that seem, honestly, mathematically unpayable.
Yes, and we are talking about this fragmentation of global trade routes.
Persistent deficit spending.
And regional conflicts that force countries to rethink their entire reliance on the U.S. dollar system.
Those slow-moving structural forces are what truly strengthen gold's role as monetary insurance?
Yes, exactly.
Okay, so to summarize the roadmap, we need a softer dollar, falling real yields, a physical squeeze from ETF inflows, and a structural loss of faith in global fiscal stability.
That's the recipe.
If all four of those align, JPMorgan's target comes into view. But we cannot ignore the other side of the coin.
If we connect this to the bigger picture, we really have to respect the bear case warning embedded in this forecast.
The downside risk?
Yes, and it's incredibly clear. It basically hinges on inflation.
What if inflation is far stickier than anyone assumed?
Right. What if central banks are forced to keep monetary policy highly restrictive for years, and the U.S. dollar stays incredibly firm?
In that world, the opportunity cost stays punishingly high.
It becomes financially painful to hold gold. In that scenario, gold could just trade sideways for years or even experience a severe decline.
Wow.
And here's the critical takeaway. The decline could happen even if central banks keep buying and the geopolitical headlines remain terrifying.
Because it becomes what Wall Street calls a crowded trade.
A very crowded, very dangerous trade. I mean, think about the mechanics of investor psychology. An asset can be strategically valuable over decades, but tactically disastrous in the short term.
Right.
Right now, there is a massive concentration of investors holding gold for the exact same tactical reason.
They're all betting on rates going down and the dollar weakening.
Exactly.
And if that macroeconomic narrative suddenly shifts and everyone realizes rates are actually staying high,
then everyone rushes for the exit at the exact same moment. And in financial markets, the exit doors are always very, very small.
yeah, they are.
When algorithms and momentum funds decide to liquidate a crowded trade simultaneously, the price drop isn't gradual. It is violent and rapid.
It really reframes the entire picture of how we should look at this asset class.
It absolutely does.
The ultimate takeaway from today's analysis is that the easy narrative is officially dead. You cannot just look at a headline, see that inflation is up, and blindly assume gold goes up.
No, those days are gone.
You can't just watch the news, decide the world is scary, and buy gold thinking it's a guaranteed safe haven. It is no longer rewarded just because the world feels uncertain.
The modern gold trade requires a much more sophisticated understanding of global capital flows. It is a highly delicate balance between institutional trust, the mechanics of yield, and monetary uncertainty.
It is a real-time daily calculation of opportunity cost.
Exactly.
So no more flying blind on the assumption that gold always wins in a crisis. It is mathematically tethered to what the alternatives are paying.
And that leaves you with a fascinating question to consider as you evaluate your own portfolio.
What's that?
If gold is ultimately a real-time barometer, measuring whether global capital is choosing the insurance of a physical metal over the income of the established financial system,
Yeah.
what does the balance of your own financial choices right now say about your level of trust in that system?
Oh, man, that is a phenomenal question and definitely the perfect note to end on. Thank you so much for joining our analysis today. Keep a close eye on those four structural signals, keep questioning the easy financial narratives, and we will catch you next time.